Hey, happy Tuesday, everybody. My name is Andy L. and I'm a realtor here in Williamson County with my best buddy, Rodney Wilds, who's a loan officer with First Bank, also in Williamson County. How you doing, man?
Fantastic. How are you doing?
You know, I'm starting to get festive. You know, it's the Christmas season. I put my Christmas tree up. It's one of those, it's like 6.5 inches tall. You know,
Nice. Spend all day doing it then, right?
yeah, I did. I put it on my mantle and I was exhausted, you know. So is your family big on Christmas? Do you put up multiple trees and stuff like that, or
We
what do you
we
guys
put
do?
up a tree and we do a little bit of traveling. Like this weekend, we were at West Virginia, Virginia, not West Virginia. We went to Nicholsville, Virginia to
Oh,
see our aunts and family, and just had a great time there and drove back. So yeah, it's the festive time, definitely.
oh, good. Get a little time off with the family. I know it's been a year, and I'd like to say thank you very much, Rodney, for being with me on this. I know it's our show; it belongs to both of us, but you're such an important part of my life and this thing that we do. And hey, I just appreciate you very much. You're a very kind man. You're a smart guy, and it's a pleasure to know you and work with you like this. I just wanted you to know that I just love you to death. I think you're the best, and Merry Christmas to you.
Well, same to you, buddy. I appreciate that.
You bet. It's
Same to
good.
you.
Thank you. And for we're just a little spoiler alert here. This is going to be the last show of the year. We're going to be able to take a breather, maybe, and we'll start again in January. I just confirmed with Rodney. We seem to be good on that. We'll start again first Tuesday in January. Uh, um, but for today, let's talk about. Let me see. What did I have as a title? I don't think I had a title today. What the topic? The first one that I wanted to talk about was the real estate market ebbs and flows, and it comes and goes on. A lot of times it's the headlines, it's the rates, it's the mortgage rates, it's home prices, all that stuff we talk about every week. And well, I'll never get tired of that, because that's what the market is. That's what real estate is. If you don't like it, get over it. But in this particular case, and I found this article pretty interesting, and the reason we're talking about it is I want to kind of put it to rest. It's a decently written article, but what it claims, I think, is dead wrong. And I think they're doing it probably to sell gold or something like that. But still, they brought Scott Besant's name into it. The guy in Washington. So the title of this, let's do two. We've got two. Yes, good. The U.S. housing market is poised to crash worse than 2008, experts warn, and a 50% plunge could start in 2026. Protect yourself. A little clue there. Now, Roddy, do you have any particular thoughts on the title?
Um, yeah, it kind of ruins the article for me. Honestly, the title does, but let's get into it before I ruin it for everybody else. But it's like it ruins it when it compares, anything somebody says that's going to compare to 2008.
Mm-hmm.
Uh, that's that's
That's
just
it.
me though. Yeah.
Got it. No, and I think that's probably what caught its attention, because the truth is, you and I have been through 2008, and we're not sensing any of that. But we'll go through this. It's a pretty short article. We'll go through it real quick. And Ronnie, we didn't talk about which article for the riff. So let's get started. The 2008 housing market meltdown was brutal. Home values collapsed. Millions of Americans were pushed into foreclosure, and trillions in household wealth evaporated. Now, housing analyst Melody Wright, gonna have to remember that name. Melody Wright is warning that the next downturn could even be worse. Wow. In a recent interview with Adam Taggart on Thoughtful Money, Wright said that the U.S. housing market is headed for a significant correction. I don't doubt that there's a correction in our future, but nothing like what she's talking about, in my humble opinion. I think, Adam, we're going to correct all the way to a point where household median income matches a median home price, and so that is going to be worse than 2008. Can you imagine now? If I read that correctly, what she's saying, if the median household income, as it says later on, is 83,000, is she saying that homes are going to be that'll be the value? You think? Is that what she's saying?
Yes.
Wow.
Which, yeah. I mean, it's pretty wild. Yeah, it's got some pretty. I, I think we are in a. I mean, our market is what it is. They're staying on days longer. Things are not selling as fast, but people are, you know, people are not giving up on their equity like she thinks they are, if that makes sense, and just selling like foreclosure levels.
Yeah, that's right. You'd have to be a willing participant in letting it. That mean it's mind-boggling to even to think. So we'll finish the article, blow out of this one pretty quick. So Wright noted that during the last crash, prices were on their way toward that equilibrium. Geez, I wonder why. Where median incomes and median home values align, but Wall Street came in to buy those, effectively stopping the decline. This time, she argues, large investors may not step in, if that's her logic. When you were part of that back then, back in the day, and me too, did you see a lot of Wall Street purchases on homes? Was that part of the formula?
I don't. It wasn't Wall Street buying those houses. It was what. Well, I think if she's referring to Wall Street, what in my opinion took place was Wall Street created these no income and things like that programs.
Yeah.
That weren't qualified mortgages, and those were the houses that were foreclosed on, but people bought those, not government institutions and stuff like that, if that makes sense.
Yeah, mom and pop and stuff like that. People with
it was regular sales. It wasn't institutions
yeah.
coming in and saving us from waves of foreclosures.
That was my experience when we were selling the houses. That's who was buying them. You know, there was one guy. If you remember, you remember Steve Schmidt? Remember that guy? And there was one investor came in, and I got to see that one. I mean, they had a formula, and if you had a particular house that fit the criteria, they would just buy it. Everybody was like going, that'll never work. And all of a sudden, Steve Schmidt, this guy, maybe I shouldn't use his name. He was a great guy, soft spoken. Never a crossword from that guy. He started selling like 150 houses a year.
That wasn't right at the 2000. It was a little past 2008, wasn't it?
Yeah.
I call it that the gold rush. When they did have the investors that said, if you meet this criteria, we'll buy this house, and they just had to go and find it. And there were several of them that just went out and found hundreds of houses for them. So.
They did, and we all felt like heels, when we were the ones kind of chuckling. He was like,
I called it the gold rush. It was pretty cool for them.
It was pretty cool for a while. The disconnect between home prices and household income is striking, according to Federal Reserve. The median sales price of a U.S. home is reached $410 in second quarter of 25, a 42% jump over the last decade. Realtor.com estimates a typical household now needs to earn roughly $118,000 a year to afford a median-priced home. The actual median household income, as of 2024, when the latest data was available, just $83,000, according to Federal Reserve. When asked how far prices would need to fall to restore balance, can you imagine this? Wright didn't mince words. It's going to be near your 50% and much greater in certain areas. I was like I couldn't believe it. I mean, can you imagine a $500,000 house all of a sudden being $250,000? I mean, that's what she's saying, right? Is that?
Yes.
Yeah, I don't think so. I guess we're doing this. I'm doing this to make fun of the article a little bit, and the punchline's coming. So there's already hints of a shift, she said. Zillow recently reported that 53% of homes lost value over the past year. Well, that can be true. The highest share since 2012, with an average drawdown of 9.7%. Wright believes the coming correction could take several years to fully play out. So she is talking about a depressive situation that's going to last until what, 2030? I mean, is that what? The market's pretty smart, and it adjusts. We've gone through some bad stuff, and it didn't take that kind of time. I mean, it's like, is it going to sneak up on us? Oh, by the way, your house lost $100,000. Really?
Yeah. I
I'm
mean, yeah. I mean, the thing about it is that we're already into a 3 or 4 year down cycle. Um, and so I don't think it's going to last 8 or 9 years at a time. Cycles typically don't last, they don't last as long as this one has. So,
That's true. And the effects for this one has been minimal by comparison. It has been minimal. It's slower. There's fewer people buying houses, but in terms of the home value, they're going down. But it's still, I'm going to call it, use the word manageable. There's she used the word crash. That's just stupid. And even correction is too strong of a word. There's just some adjustments being made. I think correction territory is 10 to 15% or something. That ain't happening. At any rate, so, and like I said, this is going to be a short one. So she's not, but now this is what kind of got my attention a little bit. She's not the only one sounding alarms. Treasury Secretary Scott Bessent recently said the housing market is already in a recession due to Federal Reserve policy. And Rich Dad Poor Dad author Robert Kiyosaki has warned that the biggest crash in history is beginning, adding that the residential real estate crashes in this scenario as well. I mean, those are two pretty big names. We know where Bessent is coming from. He's backing up the administration, beating up on Jay Powell. That's his job.
yeah.
He's the whipping boy for that guy. And Kiyosaki, that's a pretty strong word. It's biggest crash in history. But I think and I'll kind of finish it this way and ask a couple of questions. Here was the punchline in this particular article, and when I got to it, I did laugh. It said, "If you share these concerns, now may be a good time to start preparing." And it starts talking about buying gold.
Yeah.
So I think we're going to be all right. What any particular thoughts on that, Ron?
No, I mean, she picked two pretty good people to have, kind of those quotes from. Uh, Scott Bessent is already in recession, and the Rich Dad Poor Dad author, biggest crash in history. Well, he's probably trying to sell a book.
He does write my good.
But it's just one of these articles that are written to grab headlines and things like that, and promote fear and everything else. It's now could it turn from where we're at now if in our area prices are declining 2 or 3%? Could it go to a 10% or 15% where corrections and things because that would be a massive hit, if things started going down further than what we've already seen. So, it could happen, but it's definitely not trending that way. To me, things are trending better with the rates helping affordability a little bit over the past year, and they're projected to go even further down. So, I see, home prices stabling out, losing a little bit. That's not the worst thing for our market right now.
Yeah. And the thing, and that was part of the reason that I thought this would be an interesting article to bring up, because it's been my experience that people will respond really and react more than respond. A response means you've thought about it and you've come back with an answer, as opposed to react. Oh God, that kind of a thing. And when you see headlines like that, it worked. It got my attention. Crash, and so I instantly started thinking of Crash Boy. But it just reminds me that this is the same. I'm going to preach this every time I can. That when it comes to buying a house, I don't care what the market is. I mean, I do to a degree, but it all depends on you, the buyer. If you're ready, if your resources are there, if your job is solid, if your life is where you want it to be, and it's time to buy a house, whether it's moving or getting married or having a kid, whatever. I mean, the bottom line is if you can do it and you can talk to somebody that can say, look, these are reasonable numbers. And I kind of promote and Rodney, yeah, when you need to, a lot of times you can be in great shape and not know it because that's not your thing. That's not what you study. That's me. I have no clue. I talk to people like Rodney that are smart, way smarter than me about that. And so if you're thinking about buying a house, here's the point: ignore the headlines, good and bad, and talk to your lender, somebody that you trust, and they're going to tell you the truth. I think you're going to find that to be the case. That's my story, and I'm sticking to it.
Stick to it.
Okay. Hey, what do you think? Speaking of Powell, bringing his name up, what do you think he's going to do this week? Do you cut or stay?
Cut.
Really? Okay. I guess I think the lenders and stuff they've built that in, haven't they?
Mm-hmm. Yes.
I mean, because the rates today, according to my numbers, not yours, is 6.35. So, I mean, it's amazingly flat for this last couple of months. I mean, it's just been zipping right along at altitude 630.
As soon as we think we know what's going to happen, something else happens.
It does. And in the meantime, Christmas is coming. That was the other final thought I was thinking is remember, whatever condition you think that the market is, this right now is and I don't mean this in a bad way, it's the slowest time of the year. 2 weeks before Christmas, how many people are out looking at houses? Some, but not very many. Let's see. You know what time it is? Do we know what time it is? Yes.
All right, here we go. I can't get a mortgage even though I have the money and income. Can you believe that? That's this is a good one here. Buckle up on this one. Let's see here. I can't get approved for a small loan for a home costing $150,000. I'm putting down 40. My credit score is 760. I have 70,000 in the bank, 30,000 in retirement accounts. I have 2 credit cards with 20,000 limits that are paid off every month. My current contract job I've been working for the last 13 months pays me around $4,000 to $5,000 a month. My car is paid off and I have a perfect driving record. All right, keep the driving record in mind here. I make an additional $2,000 a month or so if I decide to make and sell art. I have less than 15,000 student loans and no missed payments. I'm a contract worker and self-employed. I pick up bigger gigs when those aren't around. I work for myself. I've never missed a payment, never been late, never been evicted or arrested. How am I supposed to buy a home in the tech creative space? In none of those jobs are W-2 and banks keep rejecting me. Estimated payments be like $900 to $1,000, including taxes and insurance. So I can't afford $1,000 a month out of my $4,500 income. Make it make sense. All right. Well, first of all, we got some really good comments on there, but let's jump into this a little bit. I'll make it make sense. I'm surprised that it's tough making sense for you on this one. There's an issue called ability to repay. The whole reason we got into 2008 crash was because a lot of the houses that people were qualifying for were just basically like stated income, stated assets, things like that. The ability to repay was not important back then. That's what caused the 2008 crash. After that, you've got to have a consistent work and a consistent job to be able to qualify. If you go through your thing, and then somewhere later in the comments, you also talk about, you did this for a while, you did that for a while. But if you're not making income consistently, and then the second, you've got to be consistent on your income. Going from contract job to you was doing, something else W-2 before, and then before that you were selling art when you wanted to work. That's not this is a definition of not consistent. if you're going to be a contract worker, your contract has to explain that you're going to be there for 3+ years, and typically contract workers, that's why they're contract workers. As soon as the contract's up, they're out. They go to another job, find another job, or whatever it is. Contract workers are not usually 9-year employees of a company. So that's the thing about consistency. You have to have, it has to be projected that you're going to continuously have this income coming in, and then you've got to have a history of making it. Now, if you're self-employed, that'd be fine, but it looks like you're not claiming all your income or paying taxes on it. So if you're not claiming your income, that's what we use. A really good comment down in the section, and we'll get to some of those comments. One of them said, "You can't tell Uncle Sam you make $10,000 a year and then want to borrow from his cousins, Fannie and Freddie, and say you make 100." So I thought that was a pretty good analogy on this one here. So basically, self-employed income is very easy. It's very easy to figure out. The problem typically lies is because the owner of the company or whoever's filing taxes takes advantage of their tax laws or cheats. Either one. I don't know. I don't see everybody's taxes, but they typically find a way to write off almost all their income. And that's what we use. We use the net income of your self-employed and your W-2 employee. We use the net income to figure out their income. So that's the problem here. Is that the way you've done your income? It's not consistent. It's not 13 months at best is what you've got, and then you haven't probably filed taxes on that. And so really, yeah, the income is about as bad as it gets, even though you got a really good down payment and a really good credit history. Now I will say your credit history is made up of 2 credit cards and some student loans. So although your scenario would be something that I think would be a good risk for a loan, the income just wouldn't ever work. You would need to straighten your income out, and then I think it'd be an excellent loan for you there, as long as you qualified for the payments. You just got to count the income. So
got it.
Let's jump in here and check on this reality check here. Some of these comments. Somebody says you'll have better odds once you hit 24 months of self-employment. You will, but you still have to file your taxes. Like, you have to have a 2-year history, but you still have to file your taxes. And we can only count what income you've done on there. So you have to count your taxes and what you've actually made if you want to use that as qualifying income. See here, the poster says my self-employment goes back to 2020, but they want to complain that I didn't make much self-employed during the years I was working full-time making $100,000. Like, no shit. I didn't make much doing side gigs. I was working full-time making more than I did self-employed. You quit that job, homeboy. It's gone. You can't count it after it's gone. Like, if you quit it, it's gone. You can't count it. Somebody says you're trying to make a case for income for a job you don't even work at anymore. Exactly. Max deductions and lowering tax liability by being creative makes you look like crap on paper. It's not a complaint. It's guidelines. You left your job. Why are you complaining that it no longer counts? Here's one. Find a mortgage broker that has access to more than government-backed loans. Typical conforming requirements are super strict and extremely punitive to small business owners. But there are plenty of institutions lending at similar, identical rates that will be much more accommodating. All right. First of all, I don't think anybody is extremely punitive to small business owners.
Mm.
The way you count taxes for a small business owner, a large corporation, or Donald Trump is all the same. We use the same forms. Um, what typically is the problem is the business owners writing down all of their income to save.
Mm.
They don't want to pay taxes on it. And I get it. It's like you don't want to pay taxes on it, so you don't claim it, or you write off deductions and that sort of thing to lower your tax liability. But it's going to affect what you can qualify for. Now, the other part of this sentence I do like is that there are other loans that you could find with that kind of credit score and that kind of down payment. You could probably find somebody that would lend you money, but it's not going to be at the best rate there is.
Mm-hmm.
That, you
Mm-hmm.
know, and to me, that's always been a thing for self-employed. And here's why I say, if you take your self-employed person and say they make $300,000 a year on paper, but they write it down to where they only made $50,000, so they saved $250,000. If that's 25%, I don't know, do the math. It's what, $50,000 they saved a year in taxes.
Mm-hmm.
So if they go get a mortgage that's, say, 2 or 3 points higher than the normal mortgage, I mean, they're going to pay, say, $3,000 or $4,000 extra in interest a year, but they save 50 on their taxes. So for me, if I was self-employed and I was writing all my income down and I went to get a loan, I wouldn't be upset it was a few points higher, because I'd be like, I saved a ton of money on my taxes.
Mm-hmm.
Continue with the comments here. As you're likely aware, your taxable income has little to do with your ability to repay a loan, even with everything completely above board. All right. That's the exact opposite. That's the exact opposite of the truth. It's like, your taxable income has little to do with your ability to repay a loan. Your taxable income has everything to do with repaying a loan. Like, how else are you going to calculate how can you afford it? It's because your taxable income. You know, I don't get that statement right there, but somebody believes it.
Huh. It must have made it work for themselves somehow, huh? Must be.
I don't know how. It's like your income has everything to do, whether it's taxable or net. It does have everything. It's the number. I mean, it's in the equation of how you figure out if you can repay a loan is your income. So,
Huh.
I mean, your income is extremely important when it comes to the ability to repay.
Yeah.
So, yeah, that person.
Makes sense to me.
Maybe they just missed a word, and I was just like, that statement's so wrong. I have to point it out. Let's see here. Some more about tax stuff. See, I was a government contractor making $100,000. The mortgage company made me get a formal letter from my employer that the position was guaranteed funded at least 12 months after the mortgage would start.
Mm-hmm.
Even though my salary in prior 5 years was really good, I slipped up when I was talking that while I worked for X, my employer technically is Y. This made them require I get a letter. Somebody says, you didn't slip up, you disclosed. Yeah, so, just more and more of the taxable income. The guy's still upset. Yes, I'm rejected while my friends who have no savings, high credit card debt, and expensive car payments, they're getting loans. They're getting loans because they're document. You can document their stuff. Basically to the point, this is what I say is, you've got a great advantage by writing your taxes off and not paying taxes on them. I would definitely look at a lender that could get you a loan that wasn't a qualified mortgage. They don't have to go by the ability to repay, and you could get a mortgage with a little bit higher interest rate, and I think that'd be a lot better for you than actually paying your taxes. Which I hate saying, because I love, for people, it's like, Andy, I don't know how you probably have to pay your taxes, but I'm work at a bank, so they take my taxes. So it's like, the government's worse than the mob. Like the mob might come in and give me a little bit break on Christmas. You know what I'm saying? Like, they come in and don't break my arm and just take 50% of what they're supposed to that Christmas. But man, the government just takes it before you ever see it. So to the self-employed people that get that money and get to use it and then write it off and keep it, that's that's the advantage they get, but it's hard to qualify on paper sometimes.
Okay.
That's the reality check today.
That's the riff. Yes, and to answer your question, I absolutely pay my taxes.
Well, I meant what I meant is like, I don't consider myself paying my taxes. They take them from me.
Yeah, no.
I never get to pay. They take it before I ever see it. It's like, man,
In the kind of business I am, it and you know this because you deal with realtors all the time. Some years are up, some years are down, and so it's an adventure every April. and just like you, I've written some really big checks, but I had a guy a long time ago said if you're writing big checks, it's because you should have big money in the bank, and so I never feel bad about that. I'm always happy to pay that. That was just a hell of an interesting topic there. That how the stuff that you must. I bet you get when people are calling to pre-qualify. I bet you get those kinds of questions as to why not me quite a bit, don't you? Isn't that pretty common fare for you guys?
Yeah, and self-employed, I'll say, is
the tough one.
Not a tough one. It's the most. It's probably the most common. It's very common for somebody self-employed to have a disconnect between what they earn and what they claim.
Yeah, it makes sense to me. I know that whenever I'm talking to a new potential client, it always starts with we're talking about houses and what they like and where they want to be and kind of that way. But then I have to dip into the finance to say, well, is this going to be a cash thing? Are you going to be getting a loan? Do you like your job? How long you've been? That kind of stuff. And and what I've discovered is that, and that's why when I talk to you guys, what I'll do is when I'm talking to people, I say, if you don't have a lender, talk to my guy. He's been 100% close rate for, I don't know, 12, 15 years now. So, take my advice. But anyway, when they're talking to Rodney and stuff, I try to get them to tell them everything. Because usually that first conversation is kind of cursory and surfacey, and then you get a little deeper into it.
We jump in there like a Thailand nail salon, man. We get in there and get all the questions answered. It's a deep dive into the application, and so we jump in, and try to uncover it as fast as we can. But it's very consistent with we do a lot of self-employed people, and the majority of them work out. We have some where we give some advice to, and they come back after they file a tax, a round of taxes, and they're perfect, and we go from there. So
yeah, it's been, and I've over the years, quite frankly, the reason that I have a number of reasons why I use Rodney and First Bank and his buddy Jordan, that I have used them and other processors before Jordan, down through the years, is he's decent with people, and this isn't a commercial. I'm just saying one of the things that I have to go through before we start getting serious about showing houses, because that can really be time consuming, is that pretty quick they're able to tell me, hey, you might want to hold off showing this price range. or you might want to stop altogether. It hasn't happened very often, but it has, and that's why I'm saying if you're thinking about buying a house, which don't we all, talk to a lender, talk to somebody you trust, and get that. You just have to get that thing first. And these days, the rules have changed so dramatically with having to sign agreements, buyer representation agreements before you show houses, except in Alabama. Those conversations are pretty much more commonplace. But it used to be the wild, wild west, man. Did you get a buyer rep sign? No, you're not getting paid. See ya.
Yeah.
By the way, before we get all done with today's show, I'm going to be bringing up an article that was sent to me by somebody that Rodney and I know very well, Wendy and Phil. It was an article in Zillow about Zillow and the climate stuff. So I'm gonna maybe do more of that last year. Have people submit articles for us to kind of scrutinize. It's actually a pretty good article. So we'll get to that in a minute. But to continue on, where we've gotten now is first we were talking about crashing and all that kind of crazy stuff going on. But prices are moderating. They're going down a little bit. And if I were to show you, I'm going to show you something here. This is a little behind the scenes. In the real estate business, I have access. I know this is almost impossible to read. But in the Nashville area, this is called a hot sheet. And in the last 7 days, this tells me everything that's going on in the real estate market, all inclusive for single family homes in Nashville. And in the last 7 days, there was 286 new listings. There was 225 price changes. The reason I bring that up is price changes, 95% are price cuts. That's what that is. And when you see in this thing, I know it's impossible to see that it's over here. I'd have to mess with it. But these are all prices that have been dropped. And the reason I bring that up is prices are coming down. They just are. And I'm telling you, there's a database right there that proves it, that's what's going on. And that's just in the last 7 days. So this article is from Realtor.com. And of course, I've said before many a time, love Realtor.com. They're very home sales positive. That's what they sell houses. They help us sell houses, so they tend to have a positive spin. The article says, 2026 brings a turn towards affordability, even as home prices keep rising. The year ahead is likely to be a more affordable one for many home buyers, even though home prices continue to climb for sellers. Well, I just showed you evidence in the Nashville area that prices they're being cut. Part of that is this time of year, part of it, but that's still a significant chunk of price cuts, I would say. That's my take on that. The reason affordability improves is we expect mortgage rates to be lower on average across 2026. In fact, monthly payments are projected to drop for the first time since 2020. When she says that, how do you interpret that, Rodney? I know you interpret as lower money, but how do you see that particular comment?
Well, I mean, I think it's pretty, maybe just oversimplifying it, but it's just, rates are going to be lower.
I guess what I'm asking is, if you were to guess, would you say it's significant? Well, we'll leave that for later. On top of that, incomes will grow, dropping the share of monthly payments which buyers have to fork over to buy a typically priced home below 30%. If you were to guess, and I don't know if you can even, the number of all the buyers that you have on average, is it 30% of their income is what they're spending on the house? Not the high dollar stuff, but in general?
Yeah, I would say I'd say if you averaged every single loan that we have,
Yeah.
I bet it would average 30% around it within a few points.
And that's responsible according to Dave. Dave says 25, but 30%
Yeah, I
pretty
mean,
good.
it's it's the affordability's just climbed. I mean, maybe 10 years ago it was closer to 25 or 27.
Yeah.
But not, I would if I'm going to estimate ours today, I'd say it was 31, 32.
Yeah. This builds on the modest improvement in affordability we saw in 2025 to bring the cost under this key benchmark for the first time since 2022. Improving affordability will help bring more sellers back into the housing market, boosting inventory by roughly 9%. These are projections, I guess. And buyers and sellers will more often meet in the middle, helping push transactions up a modest 1.7%. And here's the mortgage rates historically. And this is what we were talking about earlier. I mean, that has been flat. That's a long time, isn't it? I mean, that's
Yeah,
that's
yeah,
coming up on flat for 3 years, man.
yeah. It's like for 23, it hit that 6.09 right there. And then, of course, we're entering 26. So,
God, I mean, 6.61 to 619. That's in terms of basis points. What is that? 40, something like that, over the
right.
course of 2.5, almost 3 years. That's flat, man.
Yeah, I
if
mean, look
pe-
at it beginning of 23, it's only 10 basis points difference.
I'm telling you, and I mean, if we're looking for consistency, there it is. you know, Consistent with our expectation that mortgage rates will remain low. Low. Interesting. Mortgage rates dropped 4 basis points this week. Now, see, that's I appreciate dropping points, a little bit, but 4 basis points, I see that as, I don't know, minimal. Moving towards the low end of the narrow range they've held since mid-September, which are some of the lowest rates since October 2024. Really? Okay. Mortgage rates am I reading that wrong? No, I don't think so. Mortgage rates for a 30-year fixed home loan decreased for a second week to 619, which is good. And I know that you're probably selling those for a lot less, right? Wouldn't you say? Probably?
Yes.
Yes. For the week ending December 4th, according to Freddie Mac, rates average, sorry, I'm going to do a little maintenance.
Need your "we'll be right back" sign for that
Yeah,
sip.
I should have, damn, I missed it.
Come on, man.
Rates averaged 6.69 during the same time a year ago. Put simply, even though the Fed is likely to cut rates at next week's meetings, there you go, I don't expect to see a big impact on mortgage rates for sure. We could see more volatility as economic data delayed by the government shutdown continues to roll out. Can't wait to see that. For now, mortgage rates are quite steady. Weekly trends in housing data have also been relatively steady. Clearly, prices continue to hover close to a flat, slipping slightly this week as new listings ebbed and active listing growth slowed. Homes were on the market for 2 days longer than this time last year, narrowing the gap with activity relative to earlier in the year. One thing you couldn't see on that graph that I had up there, not graph, but the chart, whatever, the spreadsheet, was the days on market. The days on market was insane for a lot of those houses. So if you've got a house listed and it's on for a little bit, I'm telling you that's pretty common these days. So finally, it says, let's zoom in on the luxury trends in two pandemic era hotspots: Nashville, that's us, yay, and Austin, Texas. There are many commonalities between these two markets, but as the national luxury market has softened in recent months, Nashville's high-end tier has remained steady while both markets had similar luxury price points in 2018. Nashville's high-end is now more than $250,000 more expensive. Well, woohoo, look at us.
Yeah.
That goes, and I bet you Williamson County's even doing better, wouldn't you think? I mean,
I would assume, just with our school districts and the things that it offers outside of Davidson County, like,
yeah, it's an amazing thing. And so the reason I bring this up is that clearly the topic in the news macro level is that prices are going down. The crash thing was, I'm not going to say it's stupid, although it was stupid. The idea is that prices are going down, and that's sort of accepted. Everybody knows that. In this article, they're calling it an affordability, but prices are still going down. If you're selling a house, you may not love the way that it's, going for you. I mean, price cuts. And I think I was telling you about this a couple of weeks ago. When you're a listing agent and you're looking at these price cuts that we were talking about, if you don't have it, if for anybody that's trying to sell a house and facing price cuts, with any luck at all, you had that conversation with your listing agent the first day. And that is, if things don't go the way you want, are you willing to take less money? And if you are, what's the pinch point, the ouch point where you say no more, no mas? I mean, you've got to have, hopefully you've had that discussion. Now, I will also say to somebody that's had that discussion about when prices are dropping, how often to do it, and how much to do it, that you may say that your point of failure, where you say, that's it, I'm out, will probably change as well. If you listed it $700,000, you say, I won't take anything less than $650, and you're 60 days into it and the price is $660, chances are pretty good, Joe, if you want to sell, you'd be willing to take less than $650. I'm talking to you sellers out there. This is normal stuff. So hopefully you had that conversation. Any thoughts on that, Rodney?
Yeah, it's you brought that up. It's interesting. I was talking to an agent this week, and he was talking about, the conversation. The seller was, getting anxious, and I was like it's, we had talked about it, so I was like, it's why is the seller getting anxious? Because it's only day 40. Like, it's supposed to be 70 something days on the market. Why is day 40? Like, they're upset, or not upset, but why are they getting anxious talking about price drops? I'm like, because I don't know. I'm not a realtor in that area, and that's what your area is like, do you drop it the first 70 days when nobody's looking at it? I'm like, because it's supposed to be on the market 70 days. So I'm like, yeah, it's a tough call to have, or a tough conversation, especially if you don't, like you said, have it up front.
You got to have it. Mm-hmm.
For me, if I'm selling something, I'm like, Andy, what's the days on the market? And if you say, hey, the days on the market, 75 days. And I'm like, well, I really shouldn't be, I should, hopefully it sells faster, but 75 days is about when I should be expecting this thing to sell. So
but there is a measure. There is a measure of success there's a metric that you can take into account, and that is, how many showings are you having? If there's been 0 showings, it's just priced way too high. It just is. Now, in this market, you can be down to 2 and 3 showings a week, and I'm going to still call that reasonable, because this market, let's just call it what it is. It sucks right now. It just does, But that's how you can tell if your pricing is whacked or just a little bit off base. No showings at all means that it's way off. If you have some showings but no offers, that means it's just a little bit too high, and come down a little more. And you'd be surprised. A $10,000 drop for a $600,000 house can get a contract to come in. It's the dumbest thing it's like offer less, geez. But that's been the case. So I wanted to add, I'm going to dip into one article before we touch base, because we're almost out of time. The last one will go pretty quick. And this article is, and it falls into everything that we're talking about. And here it is. The idea that Redfin reports big housing market news for home buyers. Here's the short story, what this thing is saying. As American home buyers confront affordability, new data suggests an intriguing trend has developed in the housing market. I'm going to cut to the chase on this one. The people that used to buy mid-level, mid-tier houses, call them $500,000 and $600,000 houses, whatever, are now the ones that are buying the first-time buyer houses. Whereas it used to be the people that struggle to get their, and I don't mean that in a bad way, but when you're buying your first house, you're going to struggle to get your stuff together. It's the job and the resources and the down payments and the freaking out. You go through that. That's what you do. Well, now the people that we would typically work with to do a lateral transfer from one house to a slightly larger one, those are the ones that have taken the place. That's the new data And I'm not laughing. I guess it's not funny. It's those mid-tier people are doing the first-time buyer houses. Had you heard that?
No, it makes sense though. With again, affordability issues, it's driving people to to what they can afford.
Yeah.
And then the new buyers getting in the market. I mean, if they're going to get in the market, they're getting in on the lower end. So now they've even got competition from move up buyers. I
Yeah.
mean, ugh.
Yeah. And I tell you what, you show me a guy that's doing a lateral move, competing with a first-time buyer for that first-time type property, they're gonna win because they're bringing equity with them. You know what I
Right.
mean?
They can
Anyway.
wave. Yeah, we'll get back to waving stuff.
Yeah, absolutely. So here we go. We're going to do, it's a little off the top. That's pretty good jazz music. I'm really disappointed that I didn't do the be right back. Damn. I'm joking. So Wendy and Phil sent this article to Rodney. They are longtime viewers of this crazy little show. And she sent this, and I thought it was pretty interesting. And it is, now this is going to be different than even the link that I sent you, Rodney, but the point is the same. Here's what the article says basically. In Zillow, they used to have climate change, well, they would have climate predictions. Now, in Southern California, Southern Florida in particular, if you're along the coastline and stuff and there's hurricanes and flooding and that kind of stuff, these predictions would be kind of important, I would think, if you're looking down there, that kind of stuff. But what had happened was, and had you heard about this particular article, Rodney? So here, I just want to read. It's only going to take a couple of paragraphs. It looks like I've outlined the whole damn thing, but it's really just a couple of paragraphs. It goes really fast, but I thought this is interesting because it's a story about transparency. Here we go. Until recently, when you looked at a house for sale on Zillow, you could see property-specific scores for the risk of flooding, wildfires, wind from storms and hurricanes, extreme heat, and air quality. The numbers came from First Street, a company, a nonprofit, okay, that uses peer-reviewed methodologies to calculate climate risk. Remember that. Calculate climate risk. But Zillow recently removed these scores after pressure from the CRMLS, that's the California dudes, one of the largest real estate listing services that supplies its data to Zillow. The reality is these models have been around for over 5 years. This is the defense. This is great. The reality is these models have been around for over 5 years, says Matthew Eby, CEO of First Street, the people that supply the risk documents, which also provides its data to sites like Realtor.com, Redfin. Zillow started displaying the information in 24, but Realtor.com incorporated First Street's flood scores in 2020. And what's happened is the market's gotten very tight. Now, this is the CEO of the guy supplying the information. And now they're looking for ways to try and make it easier to sell homes at the expense of home buyers. I hope Zillow Redfin is paying attention to what this guy is saying. In my humble opinion, I have a different view of that, and I'll get to that. The California Regional MLS, like others across the country, controls the database that feeds real estate listings to sites like Zillow. The organization said in a statement to the New York Times that it was suspicious after seeing predictions of high flood risk in areas that hadn't flooded in the past. When Fast Company, that's who wrote this article, asked for an example of a location, they pointed to a neighborhood in Huntington Beach, but the area had actually just flooded the last week. They weren't ready. They clearly weren't ready for that question. Prove it. Okay.
Yeah.
Oh, wrong. They weren't ready. I'll finish with this, and then I've got my thing on it. In a statement, First Street said that it stands behind the accuracy of its scores. Our models are built on transparent, peer-reviewed science and continuously validated against real-world outcomes. In the CRMLS coverage area during the Los Angeles wildfires, our maps identified 90% of the homes that ultimately burned as being being at severe or extreme risk, our highest risk rating, and 100% have some level of risk, significantly outperforming CAL FIRE's official state hazard maps. So when claims are made that our models are inaccurate, we ask for evidence. To date, all the empirical validation shows our science is working as designed and providing better risk insight than the tools industry has relied on historically. Rodney, do you have any thoughts on this so far?
Yeah, I have a couple. One, I'm not a. I get the whole transparency thing, and I'm all about transparency. However, from being in banking, being in mortgage lending for as long as I have, nobody consults these dudes on anything. Like, no, nobody with money that's lending out is talking about rules and what's the safest way to protect buyers, what's the safest way to protect lenders. Nobody is reaching out to Greta Thunberg here and asking his company's opinions on climate. Now, it, for me, I see these things, and I've seen their models, and I've seen all that stuff, and I pay no attention to it. But I didn't think other people would either. So if other people are paying attention to it, and I don't think that one, I think it's like a weather. If you want to know what the weather is or predict it, you get the weather rock, right? And you go outside and you see if it's wet, because weathermen aren't even good at what they do. So predicting these, you're predicting California's going to have a wildfire. Congratulations. You're predicting a hurricane in Florida. Congratulations. So is everybody else on the face of the planet, and we already do that with insurance. So I like the information if it was useful. But I'm betting now that people are paying too close attention. And if somebody ever makes a decision on buying a house due to that guy's data, to me, they've made a terrible decision. Like, it shouldn't be in the fact. So I'm glad they removed it and have a little bit more data integrity about what they have on their site than, especially something predicting weather. I mean, that's so ridiculous. Like a flood map is not a prediction of flood. It's just a little bit of protection if it floods, or a lot of protection actually. But anyways, we have insurance for those things. Those are not consulted by FDIC, Fannie Mae, Freddie Mac. It's useless information in my opinion, and I'm glad it's out of Zillow. I don't think for one bit removing inaccurate or possibly inaccurate information, that's not being restrictive on transparency. That's actually taking care of your customers.
You've taken the words right out of my mouth. The bottom line is, I know that in the lending industry, you guys are crazy on disclosures. I know in the real estate industry, we have 90% of all the, it's probably 95% of all the documents that I submit outside of the purchase and sale agreement, which 80% of that is disclosures. All of it's disclosures is like, look out for this. Hey, Mr. Buyer, look out for this. Look out for the. I mean, it's just dozens of pages of be careful of this. Make sure you understand that. Do you get that? Transparency is everything, and people can make decisions. Did the roof leak? It did, but we had that fixed. Whatever. You're going through all that stuff. But then you had, and so your point, I won't make the point twice. I guess I will here, because here it comes. They're trying to sell information that changes people's mind about a house that has no bearing on anything.
Right.
Nothing. And if they were willing to put money where their mouth is, meaning, if they were taking bets on that and had to pay out when they were wrong, I might think differently about it, perhaps, But,
and I would say, I would even give them credit to saying if they're doing this, they're probably got the latest, RC 3000 that predicts floods or wildfire, but it's still like predicting weather, predicting things that, it just has no, we already do that with flood risk, wind damage, things like that. Fire hazard insurance. So we already cover those things, but I'd say, give the guy credit. He may provide great data, but it's just not data that is really needed to make a decision.
Yeah, he's trying to sell a house based on, well, it might catch fire. I
Yeah.
don't think so. I'm not crazy about that. I thought it was an interesting article. Thank you for Wendy and Phil. For anybody else, if you have ideas on that, my contact information is in the description box. Easy to find. I thought this was a really interesting. It really was an interesting article, and I appreciate that to them. Well, that does it for 2025. Button it up for this year, Rodney. Do you have any final thoughts as we head off into the proverbial sunset?
No, just keep on keeping on. Have a great winter holiday, everybody watching. Have a great Christmas, all that, and safe travels. And we'll see you in 2026.
Got it. Rodney, thank you for everything. And thanks for everybody that's watching this thing. We'll see you next year.